buddy. All right, welcome everybody. Thank you for being on. We have closed the 23 chapter. We are so already roaring into 2024. I'm excited to go through a bunch of these stats with you. As always, thank you for being on. We run from 10 to 11:30 a.m. 90-minute market report. So we officially have all the data from 2023. You've probably seen a few news headlines around the country just on some of the data that's officially came out for closing out 23. How do you guys feel about 23? You guys happy about it? You happy to close it out? You ready to jump into 2024? So before we begin, I'll introduce myself in case any of you are new. My name is Johnny Christensen. I've been in real estate 17 years, co-owner of the Red Sign team. I own the KW Westfield office down here in Orem, and I'm the state director for Keller Williams, which basically means Gordon tells me what to do all day, every day. Thank you, Gordon. Well, let's get rocking. You do boss me around. Come on, Gordon. People think you're shy, but I don't know about that. Well, as always, I'll share my screen, but before we get rocking, how many we got on already? 45. I want everybody so far on, I want you to type in the chat, what is your biggest, boldest prediction for 2024? Home sold, could be mortgage rates. What are prices going to do in the state? Just give me some predictions out there. What do you think is going to happen in 2024? Robert McFarland's on. Welcome. What's your biggest, boldest prediction, Robert? Type it in the chat for 2024 real estate market. Rates come down. True. Terry, what do you think rates are going to end up by the end of the year? Robert, what are you shaking your head for? You don't think rates are going to end up lower than they are now? Sheesh. Gordon, will you kick Robert off? Just kidding.
You'd have to kick me off too, because I don't think he's wrong.
8% appreciation. All right. What else we got? So we got a couple that rates are going to stay the same or go up. Robert, what is your prediction? End of 2024, December 31st, what do you think rates will be at? I think yesterday was like 6.3, 6.4-ish, something like that. What do you think they're going to end up at the end of the year? Okay. Rates will be at 7%. Okay. All right. All right.
Are we talking mortgage rates?
Yeah. Mortgage interest rate.
Mortgage rate?
Yeah. What do you think, Brandon?
In the sevens. I think in the
Sevens.
sevens. The pricing off the 10-year, I just I think I can make a pretty good case for even if the Fed lowers rates 1 to 1.5%, mortgage rates could still push up based upon the yield of the 10-year treasury.
Okay, good. All right, well, let's talk about it. So as always, Gordon, thank you for all the work that you put into this. We got hundreds of slides now, just almost 80, 90 sources of data. And it's not even finding the data, it's finding the most accurate data. There's always some inaccurate data sources out there, and trying to piece this together in a master market report. And officially, Shoni, are you on? Shoni Ivins, are you on?
I'm here. Yep.
Welcome, Shoni Ivins, the team leader, CEO of our Westfield office. He will be my co-presenter today. So thank you for participating, Shoni. I'll do the guiding of the slides, and you say all the smart things when the right slides come up, okay? So a couple things here. If you haven't seen kind of the governor's report, they always put a good report together every single year. Let's just synopsis some of those things that came out of that report. They had a lot of talking about the old Utah to the new Utah over the last decade or two. We went from a small state, 34th population rank, to 30th by 2020. So we're considered more of a mid-sized state now. We used to have tremendous internal growth back, the last 20 years, really. 34% of our growth came from migration. Now, the last couple of years, 61%, almost double of our growth has came from migration. And you people on the call, you officially in 2018 fell below the fertility, below replacement level since 2018. We got to have a few more babies to get that going, but our positive net migration is usually around 50%. We're slowly migrating from a younger to an older demographic here in the state of Utah. We still have one of the youngest median ages out there, but that'll continue to age over the next 20 years. Less multicultural. So we were 9.5% racial ethnic minority in 1990. Right now we're sitting around 23.3. So awesome diversity and racial ethnic minority percentage there. And we've moved. I've always been so proud of Utah. I've bet my money, my wealth building, my ownership and real estate, whatnot, on the Utah economy. And we've officially kind of migrated from a strong economy to an elite economy. Utah job growth consistently best in the nation, and top COVID outcomes from some of the repercussions of COVID. But we have, as you guys know, we've gone from an affordable housing state to an unaffordable housing. Utah housing costs represent major economic risks. So we still got to figure out that elephant in the room. But let's jump through a handful of slides. I've had Gordon start pulling this. Again, if you have questions, Shoni will be helping monitor the chat. Or if you got something really awesome to say, you're welcome to put it in there. We can try to layer it in. But let's jump into the stats. Let's start with NAR UAR membership. So no doubt we've been on the decline on our realtor population in the country, NAR and also UAR. So we ended the year somewhere around 19,237 at the end of 23 and 1.5 million in the country. But even just look what we did after post-recession. So like 2007, we start tipping over, start going in a decreasing population, but that ran for years. I still project that we'll be on the decline of realtor association population this year, but it's just really questions how long will that lag last. Here is kind of just a good, membership year over year percentage. So we decreased UAR -2%. And even the growth in 2022 kind of stopped. You can kind of see flatlined right there, but there's population. I asked Gordon to throw this in because Utah continues to have just incredible opportunities. So whatever county you live in right now, here's a handful of categories. So number of licensed in area, that's the best stat we can get of how many realtors are licensed, just have a license in that county. And then the next column is number of agents selling in that area, which means it could be agents all over the state, but they actually close a transaction in that area. So you see Salt Lake County, when we pulled this, was 9,000 realtor population, but only 6,000 closed. Whereas you even look at Utah or the UCAR membership, 3,251. I know some of those are Utah Central, kind of a little bit lower, but we had 4,400 actually agents close in Utah County. Salt Lake agents, if you're going to close a deal in Utah County, you will need Shoni's permission moving forward. Just kidding. But look at that volume, man. Utah County, 10 billion of volume. Salt Lake County, 14 billion. Even Washington, you're right there at 5 billion volume. Incredible growth right there in Washington. You look at Summit County, 5 billion. Davis, Weber continue to be awesome opportunities up there. And even Cache County surprised me at 1.2 billion. And you can also see total units closed right there, number of sales, number of listings. So tremendous opportunity. And no doubt my desire for all of our people around the state is just to go get your unfair share of that market share. And here is our NAR UAR sides per agent. So this is for sure been one of the challenges. It's really gotten low at the UAR sides per agent. I know we got a lot of people that might have their license that don't close a deal or maybe one deal around there. But we officially last year were the lowest sides per agent out there since 2003. So at least the last 20 years since we put this up. But I think it goes well beyond that. One of the saving grace for sure is the average price, getting the commission up on those 4 deals. But as we see non-productive realtors getting out of the business this last year and this next year, no doubt you're going to see that UAR sides per agent. So just look at post-recession, just skyrocketed, almost doubled there for a 4 or 5 year period. Okay. Here is just the overall Utah snapshot. Utah snapshot, you can kind of see is just new listings. Just look to the right, year to date from 22 to 23, the change. We dropped 16% of listings coming on the market last year compared to 2022. And even a lot of the productivity was the first half of 2022. So even the last half, we felt pretty similar to how we felt maybe all of 23. But pending sales was down. That's under contracts was down 8%. Closed sales, we dropped 14%. Which was the second consecutive year that we dropped. Days on market almost doubled, up 68%. Median sales price down 5.1%. So we'll dig into that. Percent of original list price received from what they listed versus what they sold for. Affordability, that's positive, not awesome, but a little bit of reprieve on our affordability, up 2.9% at that 71 on the index. Homes for sale up 17%. As under contracts closing went down, no doubt our inventory just went up a little bit, which month supply of inventory, 3.1 months on average last year compared to 2022. So we're going to dive into a lot of these. So let's talk, Shoni, let's first talk about home sales. So you probably heard some headlines out there that we hit officially a 30-year record low of home sales in the country. So last year, 4.1 million homes sold in the country, which was slightly under that. So if you go to the left, we did go fall just under 2008 numbers. So we beat that, whether that's a positive beating or not. But 4.1 goes all the way back to 1995. So the last time we had lower home sales in a 12-month period was 1995 in the country. Outrageous. No doubt that interest rate just zipping up definitely affected that. And one of the things that I've been saying lately, the main difference from 2023 to 1995 is we have 100 million more people in this country. So the pent up demand, the shortage of housing supply, like the lack of building that we could have used a little bit more the last 10 years. Shoni, I know me and you have talked about it, but the theme for me is I think we're sitting on a little bit of a ticking time bomb. Eventually, if we can get interest rates lowered or affordability up or income up, we're going to see just a massive amount of business coming out the gates. Whether that's going to happen the last part of this year, but it's also setting us up for a very productive 2025.
Yeah, one thing I think that's interesting on that, Johnny, just the gap between even 2005, we had roughly 35 to 40 million less people than we do today. And so two big indicators that have impacted that since that timeline is one, affordability. But then also, I know we'll get into just we haven't built quick enough, right? We haven't kept up with the amount of demand and new households being created. And so that's been one of those big factors to look at is even though we're, significantly down on closed units and existing homes being built, the affordability is the biggest key.
Yeah. And that's what we were talking about yesterday, but it's just what would happen if mortgage rates dropped 1%? Like if they really went to 5.3, 5.5 or whatever, like I even think that 1% would just be an explosive growth. So no doubt mortgage rates are very important to watch this year. But we'll see. We're underbuilt. We have a shortage of housing. So I'm excited for when that dam breaks a little bit. You can kind of see just the rolling 12, kind of how that shapes up 2020, 2021, 2022. But here's annual new home sales. So these are we had 668,000 new homes built and sold first time out there. 668,000, a little bit better in 2022. You can see that trend line is almost right there at 700,000. So we've been under that the last couple of years. We only surpassed that in 2020 and 2021. But just look at that decade of underbuilding, new construction homes coming online. And you kind of see on a month-to-month ratio, so just slightly outpacing in November and December what we were at in 2022. So slight trend in the right direction, but there's still a lot of bottleneck of new construction coming online. So let's talk about Utah. Compare the United States to Utah. We finished the year at 38,607 homes sold in the state of Utah, all over the state, down 14%. 2022, we were down 24%. 2021, we were down 7%. So what, you add those up, 38, 45% drop since we peaked right there in 2020 of 60,210. So I know those years are coming for sure. Here's homes sold by the month. October, November, December feels very similar to what it did last year. But just remember 2020, after COVID, it kind of popped, just a bunch of great months there in the summer of 2020. 2021 was fantastic. But here is home prices by the year. We pretty much flatlined. So we flatlined 386 to 389, kind of around the country, which is what made that affordability tick up a little bit. Interest rates coming down a little bit is kind of just flatlined us right there. We still feel we're about 12% above the trend line, just from 2020, 2021, 2022 growth. Here's by month. So if you actually look at the last 4 or 5 months of last year, we were in a depreciation path, but because the first half of 2023 appreciated so much, it still overall kind of leveled out on average through the year. But the last month, last year, December, we were at 383 median price. But you can see even that, what's that, 80 basis points, almost a full percent drop in mortgage rates, I'm sure helped a little bit. And this is where that comes into play, is the U.S. median home payment. So this is purchasing a median purchase price house, putting 20% down, median interest rate, mortgage interest rate out there. What would your payment be? With the interest rate and price that we're at, the median home payment around the country right now at the end of December is $2,027, which again is double what it was in 2021. Just interest rates and prices going up, for sure doubled median home payment. But then you compare that to Utah, which we overappreciated compared to the country. You know, this is a trend line that we've thrown on there to kind of match it. But again, if you match it dollar for dollar, we're 67% above the trend line. But we did see that depreciation. So we dropped from 510 median price down to the 484 purchase price. Which you can kind of see what we did, which I always felt like we were just ahead of the correction needed that the country's kind of facing right now. We saw that a little faster earlier into 2022. So you see pretty much almost all of last year, we kind of just hovered somewhat even on that median sales price. But again, 6.82 median interest rate here in the state of Utah. And then our payment a little bit higher than the country. So we were at last year where the country was, but officially our median home payment in the United States, in the state of Utah is $2,524. Pretty pricey for the median purchase price for sure.
Yeah, and Johnny, I think that's one of the challenges too, is just like if you look at, roughly 100% increase over the last 4 or 5 years in home ownership cost, and how many of our clients have actually had a relatively large increase in their take-home income. And that gap that has been created is where a lot of the challenges lie in our industry, is that clients just don't have that affordable way to get into home ownership right now.
Yep. Side topic, I was watching Price is Right the other morning. I don't know why I was watching Price is Right, but I was guessing prices and I was so far off. Like, it's crazy how every single durable good out there has increased in price like crazy. It's just that inflation really has had a very negative toll on just affording everything. I don't even think we can go to lunch without it being $20, somewhere. Median home price comparison. So you can just see Utah, which is the teal line, and then purple is the United States, just that correction that Utah had. Which again is, if you look at the United States, the last 30 years, the only time we depreciated in real estate was that Great Recession, right? And even if you go beyond that, it almost takes us all the way to the Depression in the 20s. But that was the negative depreciation that we saw. Collectively, what is that? Somewhere around like 25% overall depreciation over that 5-year period. But if you look at Utah, we didn't depreciate as much during the Great Recession, just because we didn't have as high of appreciation precursor to that recession. But when you talk about 2021, Utah homes went up in 25% in values, 11% before, 13% before. Clearly, that makes sense why we depreciated versus the overall country. But that really is the third time we've seen home values drop in the last 100 years in the state of Utah collectively, which is pretty crazy historical. U.S. inventory's gone up. You see we're ended the 3.1 months of inventory. We got as low as 2.3 there in 2021 annualized. But you could see we're even trending higher than that. So this is U.S. inventory month by month. The red is 2023. So we even ended November and December at 3.7 months of inventory, which the only time we exceeded that the last 4 years is just right after COVID, when we had no idea what was going to happen. We thought the world was coming to an end. We jumped all the way up to almost 5% inventory, like it felt overnight. But it's been a continued progress on more inventory out there. And if you don't know the stat, again, 6 months is the number. If it's below that, we still consider it seller's market. If it's above 6 months of inventory, we consider it a buyer's market. So we still have a lot of room to go before we'll start mentioning the word buyer's market out there. Here's U.S. pending home sales index by year. Pretty much anything above 100, they consider it an expanding index on under contracts. 2022, we fell below that index line of 100, dropped by 21%. So we were at 91.1 on the index in 2022. We fell all the way to 76.6%, down almost 16% on the index. So one of my predictions, we're going to start seeing that expand a little bit. That's going to go up, hopefully more towards that trend line. But I think everybody earned their commission holding every deal together all last year, just with some of the mortgage challenges that we had. And then you can kind of see on a month-to-month basis, we ended right there around the 77 index. You already saw December trickle up a little bit. But here's those U.S. new single-family housing units completed. So that's in the thousands. The trend line, 54-year average, is basically 1,230,000. So that 12.3 on the index. 2022, we were so close, 12.2. But we still, for 16 years, we've been under that 54-year trend. So we are collecting, that shortage of housing units. We dipped well below the surplus that we had rolling into that Great Recession.
And this is really one of the causes of the huge run up that we've had in appreciation the last 4 or 5 years. Is obviously low interest rates has been a supercharger to that, but also we have not enough supply for the amount of demand that we have nationwide, but also specifically here in Utah. We have a ton of pent up demand. And have not been able to keep up with that through building new homes.
So what are the challenges of that? Shoni and I have invested into a couple developments, and we're looking to hold some more long-term commercial assets. And it's a bunch of things that need to change, right? Number one is interest rates got to come down a little bit. Construction costs are still crazy. I know they've fallen since 2021. Again, I built my house in the worst time ever, but we've seen those come down a little bit. They haven't come down enough. We still see cities charging a little bit more, taking a little bit longer than they need to. And then also, for sure, interest rates as a driver. But we hopefully we see rent go up a little bit. But just the spreadsheet is not telling us green yet on some of these assets that we're wanting to go do. And it's still creating a compounded problem of shortage of inventory. Here is just a month-to-month units completed, all hovering right there around that million. On a rolling 12. But here is increase in Utah housing units versus increase in Utah households. So purple is increase in households. So you can see just overall net increase in households. 2023, we increased 27,349 households. We'll look at the stat, but I think our net migration was somewhere around 52,000 net positive migration. You get some of that, birth rate in there, but we created 27,000 households between those two categories. We only built increase in housing units last year to 22,750. So even just last year, we created about a 5,000 gap that adds to the cumulative shortage. So that cumulative shortage ending 2023, they're still finalizing the number, but we're going to be somewhere around that 33,000 households underbuilt right now. With what we're seeing on the under construction, the builder permits, the projection of migration and fertility rates, our problem is going to get worse this year. So we think we'll be somewhere around 37 to maybe 40,000 households short.
Hey, Johnny.
Yep.
Can I ask you a question about this?
Yep.
Is this just meaning that there's 37,000 people that are living with, they're like cohabitating with mom and dad and still like waiting to buy? Or is this like there? Because in my mind, it's just like there's this pent up demand, but what ends up happening is that they just end up not moving here from somewhere else, or are they renting on their own? Like I just don't. It seems like there's a disconnect to how they calculate this number and where are those people going? Are we just assuming that they're just living with mom and dad? Is that what we're?
I think everything you said is right. I think there's probably some of this that is people that just haven't moved into the Utah yet because they can't find whatever type of home they want. I know people in their
So does
20s.
that just disappear? Like, it seems to me like if they can't move here, they would just do something else, and then they won't look back at Utah because they decided somewhere else. So that number, instead of collecting that number as something that keeps growing over time, how do we know that those numbers fall off? Like, how can we anticipate that?
Well, I think they're just waiting at the border. We got those fences and the walls up. So they're just waiting to get in. Just kidding. I think overall, just the data showing us that if we right now had 37,000 more single family homes, condos, townhomes, houses, or whatever, we could absorb those all pretty effectively. Obviously, if they came on in 1 month, but I think we've got more adult children living with parents. I think we got, multi-household generational housing living. I think we got people like just waiting outside of the state of Utah to move in. I think people are renting that would want to go purchase something if there was a little bit more inventory. So I think it's probably all three of those variables that create this. And I think that's just their best guess on how short we are, which I think we're more accurate than the United States is. So I like the stat, but yeah, I think you're right.
I also think it's important to look at just some of the increase in households for Utah specifically. We probably have a higher percentage of millennials that are stepping into home ownership compared to the rest of the country, and that kind of increase in households is actually kind of a lagging measure, because we've got to look back 25, 30 years at how many people were born in those timelines that are now stepping into prime home ownership age. And so you've got people who are graduating college ready to buy their first home. You've got people getting married ready to buy their first home. And so some of those new households being created is that kind of dynamic as well, where people are getting married and ready to step into their home ownership.
Yeah. Here's county by county. So this is even future pacing all the way from 2021 to 2030, just overall new units needed in their research. Utah County over the next decade, we're going to need about 66,000 new units, 63,000 down there in Roberts Country, 33,000 units needed. You can see basically what we did in comparison the last decade. Utah County had 50,000 units come online, Salt Lake 66,000.
This is where like I just can't believe that we could absorb 33,000 units. Like I looking at what demand because no matter what supply happens, our demand is only at a certain capacity, and with prices where they're at, I can't believe that number in Washington County. I just can't believe it.
Yeah.
Because I don't necessarily think that would actually be possible for us to absorb, because we're looking at historical supplies. Like, even when supply was high, our demand level stays pretty stable. There's only so many people that want to move to Southern Utah in a given time frame. So 33,000 just seems so insane. So
Now,
like, how
Johnny,
they came up with that number, I don't know.
This is through 2030, isn't it?
Yeah, so we still have 6 more years of net. Like, if we're stay at 50,000 net positive migration, times that by 6 more years, we're talking 300,000 more people coming in. Even just some of this
Wow.
might be migration inside the state, yada yada. But even
That's
personally,
wild.
I was looking at for St. George real estate. It's almost impossible to find some under $1 million. So even if all this units were solved, I don't know what that would do to purchase prices. If it all came at once, no doubt that would lower prices, would be awesome at affordability, but people that own real estate would go backwards. But yeah, it is interesting data. Either way, building houses in St. George might be a good idea, Robert, if you want to go do that this weekend.
I'll get on it.
U.S. showing index. Higher number means an average home receives more buyer visits in a given month. All index values are scales relative to the initial index of 100. A lot of these are 100 index. But you can kind of just see showing index has just been decreasing all last year. We were up at 223 on the index right there in March of last year. We fell all the way to 121. But you can kind of see a little bit of that seasonality too. As soon as we get out of the holidays, you kind of see it popping, the last several years. So I think January, you're going to see another pop when we look at the Q1 market report for 2024. You'll see that kind of hopefully rebound above that index or that year over year growth. Annual months of inventory for sure went up. So comparing that to Utah, 3.1. But if you look at even December, this surprised me because we peaked somewhere around September, and then we've been eating into our inventory in the state of Utah, got down to 2.9. Whereas, the country is still on a little bit of an increase the last several months of last year. And then Utah new listings, we had 51,000 new listings come on the market. Shoney took about 50% of those, but there was still half out there for the rest of the agents in the state. Utah new listings last month, 2,594 came on the market, which is pretty comparable the last several years in December. but you can also see that seasonality. So I'm really excited just to roll into March, April, May, June. Should be very healthy months for our, real estate licensed agents around the state. Percent of new residential listings sold. This is a month to month, so sometimes you'll eat into inventory from the existing month. But overall, December, we did a decent job eating into the inventory, but it's also because there's less listings that come on the market in December, and there's still a pipeline of things going under contract and sold. So we see December pop a little bit, but we probably averaged 60-something% over the last little bit. Here's the rolling month by month. So December 88, 69, 64, 57 before that. Average homes for sale. So this is when they pull the stat, on average, how many homes were for sale, active inventory throughout the year. 2023, at any given moment, we averaged about 10,000 homes on the market, higher than 2022, but just 2021. Remember how much everybody was complaining on just 30 offers on a house? People were just pulling money out of nowhere and throwing 50,000 above purchase price. So I still think 10,000 plus homes on the market, even journeying to that 21-year average, which is about 17,000 in the state. That's still a very healthy, balanced market, just on timing, working with sellers, working with buyers. Homes for sale month to month. Pending sales, you see that drop just in the state of Utah, dropped to 38,000 pending sales. The stat we don't have as well, Shoni, is the percent of cancellations. Like, I definitely think cancellation ratio went way up in 23 compared to 22. It just felt like we were holding those loans and those deals together. I know we saw some more cancellations at our market centers around the state. Here's your pending sales month to month. 2,400, so slightly outpacing 2022 the last couple months of the year. Hopefully a little bit better pipeline of closing the last month or two. Average days on market, 24 days on market in the United States. The 12-year average, 39.3, so still pretty quick turnaround. You see that we've been increasing on days of market in the United States, like we talked about, month supply of inventory. But here's Utah, which does include the under contract period in Utah, 54 days on market. Rolling 12, you can kind of see popped at 57 last month, but still better than we started 2023 at 63, 67, 61 days on market. Mortgage rates, 6.6. 6.6 is kind of where we ended up the last year. The historical average, the last 50 years, you can see there in the yellow, is 7.8. But over the last 30 years, 5.97. So we're getting pretty close to that 30-year average as rates have gone down the last several months. Here is your 30-year fixed rate annual average. Goes all the way back to 1972. What was the peak? 1981, right there around 17-18%. 10%, we got 8 6s, and we just went through that insane time where we were 3%. Gordon still has some rental properties at like under 3% finance, 30-year fixed rate. Awesome. Here's your monthly, peaked out at 7.62. We've seen some decreases the last 3-4 months. Weekly interest rates, the difference between the 15-year and the 30-year, you see is about, 0.7% mortgage rates. And this is still just boggles my mind. This is why people have had the luxury of being able to just sit and camp, even though they might have a need to go out and sell and buy. But 89% of all mortgages have rates of 5% or less. 89% of our mortgage have rates under still current mortgage rates. So again, you start seeing the interest rate drop a little bit, that the refinance market starts booming again. But even look at 3% or less, or 3 to 3.5. So add those together, that's 59, almost 60% of our mortgages in the country right now are under 3.5%. Just crazy, crazy. And then you got 4% and the poor people that got those 6 to 7%. Sorry about that. It's Robert's fault. 30-year fixed rate versus the Fed funds rate. So I love looking at this. I appreciate you doing this, Gordon, but people like Brendan even said, what the Fed funds rate versus what mortgage rates do aren't always just exact, simultaneous. So you see even 2006, 2007 time period, we were so close. The margin between those two rates was about 0.75, 0.75%. Kind of in the whole heyday of that last, 5, 6, 7 years right there when we had really low interest rates. There was almost a 3-4% gap between the Fed funds rate and the mortgage rate. But you even see that gap has been closing. So Fed funds rate right around that 5.33% at the end of December. Mortgage rates were at 6.82. So only a 1.5% gap between mortgage rates. As the market just remains competitive, mortgage officers are competing on loans, just trying to get really good interest rates. Mortgage-backed securities, held outright by the Federal Reserve. So they started purchasing on January 14, 2009. Right now, they have $2.4 trillion. Is that right, Gordon? $2.4 trillion of mortgage-backed securities. So again, they're buying two things. We'll go over the overall, but they have $2.4 trillion worth of mortgage-backed securities that the Federal Reserve holds. So as rates start going up, as they start raising that lever of the Fed funds rate, you start seeing them selling some of those mortgage-backed securities. So we've dropped about $300 billion.
And this is what's contracting the credit availability as well.
Yeah, because the Fed buying those frees up capital in the banking, the financial, the mortgage markets for them to go lend more. So when they decrease this number, there's less credit available. And that's also why you go through a credit tightening phase 2, because if they've got less money, they're trying to lend that money out to the best borrowers as well. So it's usually the, lower than perfect credit or whatever that tend to have even more challenging times of getting mortgages. But here's total Fed Reserve assets held in billions. So right now, the Federal Reserve, they own $7.7 trillion of assets. Still down 1.2 trillion. Just a little smudge right there, 1.2 trillion over the last 2 years that they dropped. But you look at COVID. COVID happened and they dumped they basically went out and bought $2 trillion worth of stuff. And that's just where the market just went crazy, right? Everything was going up. Everybody had a little bit more cash. We get into this crazy multiple offer situation. It felt like every buyer randomly had $50,000, $100,000 just to throw out a purchase price. But we've seen that kind of trend a little bit backwards. And then here's the annual Mortgage Bankers Association Purchase Index, which includes all mortgage applications for the purchase of a single family home. It covers the entire market, conventional and government loans. So 1.56, the index again is 100. So what a time to be alive as a mortgage licensee in 2004 and 5, 472 on that index. They were just giving loans away, right, Gordon? Giving loans away. We went through the Great Recession. They absolutely tightened that up, and mortgage applications just dramatically fell. We bottomed out somewhere around that 2014 and 171. Kind of went through another boom. People were refinancing like crazy. Mortgage rates were so low. You could buy a rental property and cash flow. Remember those days, Gordon? 279 on the index, but at the end of all last year, we fell back down to 156, which is the lowest mortgage purchase index. All applications coming in since what? Take that back to, we even beat 95, back to 1994. Remember the early 90s? Blockbuster, written a few videos. Weekly MBA purchase index right here for it covers all this. So here's your month to month. This even includes January. Thanks for grabbing that. 154 on the index, but we got down to 125 in November. That really goes low. So that takes us back to 92-ish, probably time period. So thank you, mortgage people, for hanging in there. Mortgage credit availability. So here's what you were talking about. This is just the index of mortgage credit availability out there, right? So we fell below that ratio at 97.7 in the country last year. The last several years, we've been above that, but that takes us back to 2012. And here's a month to month. So even December was just another record low, 92 on that mortgage credit availability index. Just less people are applying for loans. Refinances, that doesn't even include refinances on that stat, right, Gordon? Because that's what this one is. The U.S. Mortgage Refinance Index covers all mortgage applications to refinance an existing mortgage. It's a good overall gauge of the mortgage refinancing activity. Again, last month we were at 437 on that refinance index. We did drop slightly there at the end at the beginning of 2023, right when rates were kind of cruising up that last 6 months. Look how high that was. What month is that? March of 2020, 6,418 on that mortgage refinance index. Crazy. But even if you take just where we've been on this refinance, takes us into the 90s again, probably that same time period, 92, early 90s. Gordon, you've added this. I appreciate you doing this. This is U.S. historical foreclosure activity and rates. Properties with foreclosure filings in 2023 represent 0.26%, 2.2%, almost 1/4%. Of all U.S. housing units, up slightly from 0.23, but down from 0.36% in 2019. What's your comment about the moratorium that you always throw in here, Gordon?
Well, it didn't really make a difference. People are not going to give away their home when they've got a lower interest rate like this. They're going to give up their car before they give up their house payment because it's less than rent.
Yep. Yep, I agree.
They have equity as well now.
Yep. Yep. The fact that the country didn't appreciate, they still have that equity sitting in there, probably a low interest rate for them to hunker down. So they're going to have a lot more default on consumer debt or car loans or something. Whereas this would be one of the last numbers to hit because of the underlying numbers on that.
8, 9, 10, they could just walk away from it because they could rent cheaper.
Yeah.
That's not the case now.
Yeah, Gordon, we were talking yesterday, just like even me, just like visibly looking in the market of the auto market. Like we went through this time period that the cars were just so overpriced. It was outrageous. The supply chain issue. Every car was $10,000, $20,000, $30,000 over market value. Even used cars was flying up. Everybody went out and bought their fancy car, put their lift on it, put their music system in it or whatever. Over the last 12 months, I have seen so many people post on Facebook their car. I'm ready to sell my car. I'm ready to sell their car because most likely a lot of them are underwater. They can't get what they want for it. So they're just throwing it on Facebook. I even drove by the UCCU repo lot on Monday and it is full. I haven't seen it full in the last 10 years. So it is full of dope cars too. It's crazy. So we're going to see a lot of, probably repos and whatnot on some of that other revolving debt outside of a mortgage.
And if anybody knows where I can get those stats, I'm having a real challenge trying to find good, accurate data.
Yeah. We want to be able to track anything to do with distress stuff. So like we've got some credit card, we've got some auto, like obviously mortgage, but if there's any of that data out there that we can kind of watch, some of these negative consequences of the market, we'd love some of those sources. But here's your housing affordability index. 100 again is kind of that index. We are still under. We've dropped a bunch, dropped 70 points the last 3-4 years. Finished the year at 98.6. And then we don't have December yet, but even November and October, 91, 94 on the U.S. affordability.
I think the affordability index, I think almost lingering on this affordability index is interesting because of how long we were above 100. Like we were above 100 for 20 years. It's like people's budgets, right? Where you'd say, you talk about like the financial advisors say you need to have this percentage for living in your home, this percentage for food, this percentage for, all these different things. And for 20 years, that whole thing was kind of skewed. It's just crazy to see that we're at 98 and it feels like houses are insanely expensive, but we're at 90, 98 out of 100 on that index. It's just wild to see that.
Yeah. And for
Go ahead.
a long time as well, though, incomes in the state of Utah have climbed at a significant rate. And we've seen, obviously, the last couple of years, that's kind of flatlined in comparison to how much, the mortgage cost is. The last 2 years, we've almost doubled in mortgage cost. And so we just haven't been able to keep up from an income perspective. And that's definitely thrown off affordability.
Totally.
Yeah, I didn't really care to pay attention to inflation up until 3 years ago. But like when they talk about inflation is the number one risk to a government and a country, we see the negative effects of this. Just everything get more expensive, like affordability, like it creates so many challenges in our ecosystem that it is, I'll never not watch inflation now the rest of my life because of what we've went through the last 2 or 3 years. But Utah, again, compound the problem is our prices went up faster. You know, we've been under that 100 index at least the last couple of years. So finished the year at 71, just because that median payment is higher than the country by about $500. You see, we bottomed out somewhere in 64 there in October, but even the jump from 64 to 73 the last 2 months has been very helpful. But again, let's get past that 100 if we can. But let's talk about investments. Anything capping out some of those stats, Shoni, before jumping in the investment property section?
No, I think this is going to be a fun one because I was just looking at some of my properties that I bought rental wise, and just looking at, I have one property I bought in 2019 that had a 2.5% interest rate as an investment product, and then I have a similar property, similar purchase price that I bought mid 2022 that ended up having a 5.75 interest rate. And so it went from a $2,000 payment for a rental to a $4,000 payment for a rental. And so I think some of these things that we're going to get into is just how does affordability also impact a lot of the clients you're working with that are investor based, and how has that kind of shifted the last couple of years?
Yeah. I've had 100 of our agents come to me the last 12 months with some sort of rental analysis they want my opinion on, and legit almost 100% of them, you buy it, put a down payment down, and it did not break even or cash flow. Every single one of them in the state of Utah. It's just so hard to pencil investments. And again, how much investor money, how many people have been on the sideline because they can't make those numbers work, which is, you know, compounded the problem a little bit, but eventually something's got to give. You know, the government wants us to be focused on economic development, putting our money in development projects, that type of stuff. So we've got to give something. So who owns all the single family rentals? You even see kind of the presidential election coming. If you pay attention at all to Robert F. Kennedy there, the independent candidate, one of his kind of mantras that he says a lot is the risk of institutional investors. He has some crazy stat of, what is it, by 2030, 2040 or something, like 40% of the America single family units will be owned by some of these institutional investors. You're going to start seeing some bills, you know,
Fake news.
Congress. Yeah.
Fake news.
But this is the real stat. So thank you, Gordon, for pulling this. 80% of our single family rentals. So this doesn't count owner occupant. It's just the investor units. 80% of them are owned by mom and pop investors, which that's considered 1 to 9 single family rentals owned. Regional investors, they usually own 10 to 99 single family rentals. They own 14% of the market share. Smaller national investors, 100 to 999 single family is 3%, but those institutional investors, over 1,000 single family rentals owned, 3%. Do we have any people?
This doesn't include
Source.
apartment buildings.
Source, this is a made up stat. I just drew this graph earlier, Robert. Just kidding. Where was this source from,
I
Gordon?
think this one came from NAR.
Okay. But what?
This is single family.
Johnny,
Yep.
this made me think back to the slide about the percent of people who have mortgage rates under a certain amount. The big missing picture is that roughly half of the people in the country who own their homes own them outright. And so there's a whole nother segment of people who have no motivation to leave because they're at a 0% mortgage rate.
Yeah, because we've got what, 350-ish million people in the country, but I'm pretty sure we have about 100 million homes out there. And Randall, you're right. It's somewhere around that 50%-ish are paid off, like there's no mortgage on them, or maybe even a little bit higher than that. But
There's also just an increased number of clients who would be sellers who have decided to hold on to their properties when they're moving to a new property and just turn it into a rental because it has a super low interest rate on it. And so you've seen more of that happen the last couple of years as well.
yeah. And this is single family, so this doesn't account multifamily, which multifamily for sure is a lot higher stat of national or institutional investors. You don't see a lot of mom and pop that just own one big apartment building. But here is our average rental rates by county, updated August 23. A lot of these rental rates are the laggest data that we have. But you see Salt Lake County, 1570. You see Davis, Utah, Weber County. But here is the yearly average rent growth. So 2021 was a tremendous pop for rents going up. I remember even when we were renewing some of my rentals, we were going up several $100 on some of those new tenants. 2022, you can kind of see was a little bit more in the range of standard, 3, 4, 5% rent growth. Here is, but 23, Gordon, do we have data on 23 even up to August?
Not yet.
Okay, but
They're
what's your
a
guess?
lag measure.
Do you think rental rates went down in 23?
I think they went flat.
Okay.
And you'll see that I've got another slide coming up that'll show it.
Here's average rent increases 2018 to 2022. Weber County was a huge jump over that 4-year period. 2024 fair market rent set by HUD, which Department of HUD, they have to set kind of market rent for counties all around the country for a lot of their federal housing assistance programs. But this is the 2024 numbers. So these are the numbers they use on how much money they might be able to pay in any sort of grants or housing assistance programs. You see like Salt Lake County, for example, a 4-bedroom, they've set it at $2,452, $2,168 on a 3-bed, which is still under market value of what rent is. It's not like the government's ever behind on numbers, but this is one of those categories they are.
And
Salt Lake,
this is through December. So this is this next one.
right here, this one.
Yeah,
So this is through December of 2023.
correct.
So Salt Lake City is the only one that we have the most live data, but you can see rents went up in Salt Lake City. The 4-bedroom right there up $300, whereas the 3-bedroom, 2-bedroom, 1-bedroom, even those studios, those probably more flatlined. It's bigger houses, I'm guessing, or bigger units that went up a little bit. And you can kind of still see how we're sub those HUD fair market rents.
Yeah, and HUD is 2 years behind. That's why there's that lag for them. And they're having a hard time keeping up.
Yeah. Yep. Cost burdens for Utah's 6 largest counties. Blue is share of housing units that are renter occupied, and then the orangish is share of renters that are cost burdened, spending more than 30% of income on housing costs. Pretty much half of all renters are cost burdened, right? With this stat. Rent versus own. This is a family reunion stat that Gordon continues to update. I'm excited for the family reunion vision speech. I'm really excited to see what Gary's got to say on the market, kind of what his take is on 2024 for those of you coming to family reunion. If not, we'll bring as much of that data back to incorporate into our Q1 2024 market update. So these are some ones that you just pulled. This is new for this quarter, Gordon. Thank you for doing it. So let's explain this. So let's talk about like Summit County or let's talk about Davis County. Davis County cumulative surplus or deficit. So if it's a negative number, it's a deficit for renter households by AMI. So that's average median income. So number of housing units, number of households by AMI. So basically, like look at this 5,914. So 50% of AMI. Average median income. So people that make $50,000.3 a year, so somewhere around $4,000 a month, if 50% of their median income was going towards rent, right, Gordon? That means we're short 6,000 of those renter units. So like, let's look at like, where's Salt Lake County? Salt Lake County is right here. So people in this income bracket that are contributing 50% of their average median income, we're 47,000 renter units short. Am I reading that right, Gordon? So we don't really see surplus in any of these categories, but you just see the percent of people's income that's going towards their rent, how many shortage of affordable rental units there are.
This is shocking that we're this far underbuilt in some of our counties.
Mm-hmm.
And that's why the rents aren't just, I mean, I think we're at maximum rent that people can afford right now, but the rents aren't covering the expenses anymore.
Mm-hmm.
And something's got to give where we've got to start building more, or yeah.
Yep.
Hey, Gordon, on these graphics, I love this graphic. This actually tells a really good story. Could you put what the average median income is of the county on the top line? So instead of us having to figure out, 20% of AMI is like in this scenario for Summit County, 80% of AMI is 107,000. Like, what is the AMI for Summit County on the top line, so we can kind of see,
Oh.
like, hey, if you're making the average median income is this. Now, if you're only making this, we don't have enough houses for you here, right? Or in this bracket here.
Let me see if I can find accurate, up-to-date data when these slides update every
We could
quarter.
probably just do the math, like on each one. Like if 80% is for Tooele, if 80% is 77,000, we just add 20% to 77. Would that get us basically
Kind
the right
of,
number?
yeah.
we're working
The
with?
challenge is they only update these slides once a year, so we've only got this through 2022.
Okay, got it.
So let me see if I can add those.
Or maybe just like on the future, because I haven't seen us do this one before, but like on the future run on this one, maybe just highlight what the actual AMI is for those counties, so we could use those. That would be really helpful.
So like even this Utah County, if someone's making 48,000 a year, $4,000 a month, they're contributing half of that to rent. So $2,000 rental payment. We're still 17,000 units short in the rental community that have a $2,000 rent. So again, when we talk about 30, 40,000 shortage on owner occupant homes, you add up a bunch of these numbers, you can see, I think the problem's bigger in the rental shortage for sure. Here's 23 Utah housing profile at a glance. Rental households that are extremely low income, 65,000 or 19% of them are extremely low income. Shortage of rental homes affordable and available for extremely low. Was this at the end of right at the beginning of 23, Gordon?
This has been updated mid-year.
Okay. So probably a little worse, maybe more like 50,000-ish rental homes short. Maximum income of 4-person extremely low households, 27,000. Annual household income needed to afford a 2-bedroom rental home at the HUD's fair market rent.
26,000.
Yeah, percent of extremely low income renter households with severe cost burden. Extremely low income renter households, you can see senior, we have 38% of labor force, 26% disabled, single adult caregiver, people in school, affordable and available homes per 100 renter households. We're there if you just spend every dollar of your income on rent, right? Who needs to eat? Housing cost burden by income group, just clearly low income category is just the majority, right? Middle income still up there a little bit.
Well, and the challenge is we're building a fair number of apartment buildings, but they're all higher end. They're not building anything at the medium or below.
Yeah. It just, on the other side of that, with us looking at building apartments with one of our development projects, Gordon, it's just physically impossible right now with construction costs, city fees, land costs. Like we cannot even get close. We're not even trying to build fancy stuff. It's just like, you can't build something and rent it out for rent at even market rates right now, rental rates, let alone lower rental rates. It's just, we've got to figure that out, which again, you're going to see a lot of just governmental intervention if the market doesn't.
And people are expecting all the amenities in a new project too.
Yeah. Everybody's got to get a tan at the pool. I don't blame them. United States average rent growth year-over-year change. Here it is. You're right. Just totally flatlined in 23, but we went up 11, up 9 the year before. Flatline 2020, which also probably some of that moratorium, right?
And this is kind of reflecting just based on my own rentals as well. Most of them are in Salt Lake County, and 23, I would say it started around March, April, everything flatlined from that point forward. Maybe just a tiny bit.
Yeah, it was funny because 2020, 2021,
That was crazy.
Out of like the 15, 20 rental properties that we own, every one of them, the rent was going up. So that was cool. Every one of those, those couple of years, I got like escrow account refunds for surpluses. This last year, none of my rents have gone up. I can't buy anything because it's hard to pencil some of those things. But then costs of just keeping the same rental property has gone up. all 100% of our rental properties have sent us letters the last 3-4 months of escrow shortages. So every one of our payments across the board are going up because of the shortage, because property tax has gone up, insurance, even our ownership in an insurance company. Last year was a tremendously awful year for insurance, just the amount of claims, disasters, rates, insurance, just profit across the board's been.
On my rental properties, I penciled it out this last weekend. 22 went up about 30-something% in expenses, and then in 23, 25%.
Yeah.
It's just the cost of goods. When you've got, in 2019, you could replace a water heater for around $1,000, and now it's $2,200.
Yeah. Well,
Yeah.
Shoni and I have the solution. We're moving to Chile, right?
Yeah.
So we'll be there. We're not coming back. All right, rent growth month over month change. You see even the last half of last year went down. So we still had a little slight rent growth the first half, but then we corrected that in the last half. But you see that happening almost every year. It kind of pops in the springtime as they're doing renewals. Even my property manager likes to do it in the springtime just because that's the best time to do it. If you do it in the last 6 months, a little in wintertime, it's just hard to get premium rent on them. Here's your US new build for rent. 2 or more units completed.
Yeah, and I don't have a 23 number on this. I tried this morning.
Right. Which is good. It's got to be lower than 2022. Yeah. Like you're going to see a drop on that when that gets updated. Rental vacancy rates. This is the other one you got to watch. So Utah, we were 2019 3.8%, popped up to 5.4s, 23. But you see projections almost up a full percent vacancy across the country. Here's rental vacancy rates by county. Last we have is the end of Q3 data. Utah County's 4.3% vacancy, 5.9 in Salt Lake. Again, which is weird, just the shortage of units all across the board. But the fact that vacancy's gone up a little bit is just most likely due to some of that unaffordability. Annual average operating expenses per unit. So this is another one that you found some data on. So this is average operating expense of a rental property. So basically this is removing your debt, your principal payments and stuff like that. But the average Utah County rental property average operating expenses for a unit, $4,500. So actually
that's where I should have bought, right?
That'll teach you. And then monthly average operating costs. Okay. All right. Anything else on rentals, Shoni or Gordon?
I know we don't have any stats on this, but I think what's interesting too is just some question around the Airbnb market, the short-term rentals throughout the country, but also specifically here in Utah, where a lot of people the last couple of years have gone that way. And I know I have a couple Airbnbs, but there's some individuals who either kind of penciled it as an Airbnb when they purchased it, and it doesn't make sense as a long-term rental. Or with higher interest rates, things don't shake out the way they had hoped. So it'll be interesting to see how that impacts the market the next couple of years. And it might actually end up adding some more inventory to the market.
Yeah. Yep. I agree. Yeah. If you have any good macro nightly rental data from some of your sources of software you pay for, Shoni, I'd definitely love to throw that in here. And you've been great at that. Like, even if it is an Airbnb that you're going to get your net income up, you still make sure it makes sense as a long-term rental. So that is always your safety net. Where some of these speculative, even around the resort communities or, right next door to Disneyland or something, you have to bank on it being nightly. And then you get one city or state or something regulation that changes it, or the market changing, and it could go negative as fast as it went positive.
And I think that's a smart route to, when you're consulting clients, is just be aware of that and pencil it as, would it work as a long-term rental? Last thing you want to do is help a client get into a short-term rental and either legislation changes or numbers don't pencil a year from now and have that come back on you. And so just guide them the right way and look at, can this make sense as a long-term rental if they had to pivot, and you'll put them in a better position for sure.
Yeah.
And for your own properties if you're buying them.
Yep. So real GDP. So this is the United States annual year-over-year change, up 2.5%. Usually we do want to be in that 2, maybe 3% GDP growth. So still pretty healthy, which has been surprising. We're going to look at some stats that may change that. But other than the drop of 2020 overall down 2.2. But here's your quarter by quarter. So Q1 and Q2, we had those 2 consecutive drops. You saw the rebound of COVID, but pretty much the last 18 months, 2 years, we've done pretty dang good on just that
Yeah,
two.
but
three-
if you also take out the government spending out of this, we are in the negative and have been for 3 quarters.
Well, that's why they don't give us the stat.
Great
with
I know,
how much
I
spending
wish
we're
I could,
doing.
I wish I could figure that out.
When in doubt, print some money. I wish we had that ability. US unemployment annual 3.6. Again, just this is our saving graces. I hear more and more news reports of a soft landing for sure is potentially probable out there, but it's just because of our unemployment is so low, our job market, our job growth, a lot of those things. A lot of times when you have the inflation in other countries that we have, the unaffordability, like you just see unemployment skyrocket. So if our government's done something decent, they've helped maybe keep our job market robust. U.S. unemployment on a monthly basis, just awesome. You saw just overnight, 10% unemployment growth over that COVID 30-day period. We thought the world was coming to an end, but we rebounded pretty quickly. Job openings, I still, I know month to month this is even lower, but the amount of job openings out there is still, it still shocks me when I see the stat. You're seeing, job openings, a lot of restaurants, retails, hospitality, travel, like they've done a great job recovering. You're starting to see that decrease a little bit on job availability, but one of the things when we journeyed through that great resignation, where pretty much everybody was questioning whether they want their job or not, or they want to go get another job. If anything's changed, even behaviorally, you just get a lot more happiness and satisfaction of people just staying in their job, but you still have quite a bit of job openings out there.
Well, and demographics also come into play. We're halfway through the boomers retiring now, or more than halfway.
Mm-hmm. Yeah.
So that's affecting the job openings.
Yep. Yep. Here is your, census by region. So job openings versus quits. Job opening decrease pretty much over the last 12 months. We're considered the West, which is down 28.58. So we've had the lowest drop. I mean, the biggest drop right there in job openings and job quits. And job quits is you quit and go to something else, right, Gordon?
Yeah. So
Real
people who are job hopping, they're not as comfortable making that change.
I was close. I was going to go be a Navy SEAL or something there for a second, but I'll stay here. I'm with you, Gordon. Your real unemployment rate, U6, includes underemployed, marginally attached, and discouraged workers. So your U3 is just true unemployment. U6 includes some of those people that might want more hours or they're not happy about their job. I don't know how they totally get that stat, but that's about another 3.3%. But again, just tremendously low unemployment. Here's your month to month. You just see that consistency over the last, several years, which probably fueled a little bit of the aggressiveness from the Fed. They felt confident in, some of that job market stuff. Here's your annual labor force participation rate is the number of all employed and unemployed workers divided against the civilian population. So United States, we got 62.6% of our civilian population in the workforce. Utah, 69%. We work harder and longer, but we also have a lower median age, which it reflects that category as well. Here is your, 25 to 54 is your blue, 55 plus is your purple. 38% is in the workforce. 25 to 54 is 83.2%, which is either they retired early or it's our kids. They don't know how to work these days, right? The next generation's always the one that screws up America. Just kidding. Real wages year over year. So real wages it includes the income decreases or increases, but it also takes into play inflation. So even though our incomes have been going up because of inflation, it hasn't felt like that the last several years. So 2023 was the first time real wages taken into inflation into account. We went up 0.8%, 2021, 2022, even though incomes might have been going up, it didn't feel like it because our dollar went less far, right? United States real average hourly earnings month over month. So other than maybe August, for the most part, all last year, we saw some United States real average earnings go up. Weekly payroll wages index of all employees total private.
And this doesn't include inflation. So that's why you're seeing above the line trend.
which is the purple trend line, the percent change. So 2023 weekly payroll wages went up 6%. 2022 they went up almost 10%. 2021 they went up 8.7%, but inflation almost wiped that out, right?
Yep.
So let's go over some just of the deeper categories of inflation. You know, we'll probably skip some of these due to time's sake, but CPI is the headline. You also see core. Core inflation excludes energy. Headline does include energy. So let's look at a couple of those. So CPI includes energy and food, which is the yellow line. That is the one that traditionally they're talking about on the media, right, Gordon? Whereas core excludes energy and food just because those tend to be more volatile, right? You have a war here, you open up our oil reserves here, or you cut gas prices here, or whatever. We can move or we can manipulate, you know, the actual normal CPI. But when you exclude energy and food, it's a lot harder to manipulate that core inflation number.
And what surprised me is if you take out energy and housing, we're still above 4%.
Because energy, we've just seen natural gas, we've seen
Yeah, it's finally
fuel,
come down.
gasoline drop. Here's some of the, you know, projections still. They have made, you know, progress on it for sure, but we still need to get down to that 2% target, whether it's core or, you know, normal CPI. You updated this, you know, a car. So 2023, a car, average car is 48,000. In 1989, that car was 15,000, but adjusted on the inflation percentage, 37,000 is what that car would have cost in today's dollar in 1989. So the real change, including inflation, we're paying 28% more for cars than we did in 1989. Same thing for gas, we're up 30.51%. Your house, tremendous jump there, 69%. And for a long time, because mortgage rates almost buried the rising cost of housing, we're officially up 1%. So mortgage payments up 1% compared to where it was in 1989, which is still awesome. That's a good number. So, you know, as far as the mortgage payment goes. And then wages in 2023, average wages, $29. 1989, it was $9.80. And then adjusted for inflation is $23. So we're actually up on the wages, but again, the pricing of homes, gas, cars, those being up, definitely have eaten into that wage increase.
Well, I also think it's interesting if we're looking at this timeline, like 1989, how much simpler was life back then? Like we're now in the, you know, membership economy. We have people who, you have Netflix subscriptions and Amazon purchases and all these different complex things where people spend probably a little bit more freely today than they did back in 1989 because it was just easier living back then.
Yeah, it's just whatever your discretionary spending was, there might have been 30 or 300 categories competing for that discretionary. It feels like now the same discretionary spending that you have, there's like 30,000 things competing for us to spend money on, right? What a time to be alive. You can see just where a lot of the inflation's gone the last, 24 years. Hospital services, just outrageous. I don't know if you know this, Shoni, but we have some issues in our healthcare system in America, up 227%. TVs, though, man, TVs down 97%. Those first versions of TVs back then, very expensive. New cars only 24%. Clothing's down a little bit. Might be just in efficiency and, you know, manufacturing or something. Hourly wages. But here is your December 2023 Consumer Price Index. You can see the different categories. So like we mentioned, fuel, this is a 12-month percentage change. So from December this year, just barely, to December 2022, fuel's down 14.7%. Natural gas is down. Energy 1.9. There's so many government entities and special districts and stuff like that. So that is always one category that we can kind of maneuver a little bit. You see median home price, you see real rent growth, real median home payment. The last couple quarters, these categories are a lot more higher that were contributing to some of that inflation for sure.
You can see where their lag measures are, what they're reporting on the left and what the actuals are that I've been tracking. That's where the CPI is off.
Yeah. Flexible versus sticky. Your sticky is kind of more of your bundled goods that are just really solid ones. Flexible might have a few more categories in there, but just overall, you see, that trending downward, 6.7 down to 4.6. It still hasn't happened as fast as they hoped for, but we've made progress the last 12, 18 months. So your former profession of being a purchase manager, you've added a bunch of just what's going on in the manufacturing, future orders, kind of the retail markets, but the producer price index, final demand, 12-month percentage up 1%. So that's really slowed down the last 12 months, 2021, 2022, and people just were buying a bunch more stuff, I guess, that kind of increased that. Real personal consumption expenditures. We're always good at spending a little bit more money every year, even though we might make a little bit more money or whatever. We find ways of putting it somewhere. But just look at that, speed at which we were saving money right when COVID happened. And obviously everything just being shut down and impossible to go on vacations and buy things sometimes. Market-based personal consumption expenditures, excluding food and energy, changed from 1 year ago. So we're up 3.2% in personal consumption expenditures.
And this is the chart that the Fed really watches closely. This is their favorite.
Because when they start seeing that trend down, they know eventually that's going to affect our GDP going backwards. So that's one of the things they don't want to happen is this thing going down, but it popping as much as it did just because there's more money in the market didn't help.
That's
Revolving
crazy.
consumer debt. Revolving
So crazy.
Revolving consumer debt, seasonally adjusted, what's that? $1.3 trillion of revolving consumer debt. Crazy. We're up there. We're up there. Record. Pay off your credit card bills, folks.
Yeah, and I think,
Federal.
too, that's a product as well of just funds from, COVID timeline running out. So people's household balance sheets are increasing when it comes to debt and decreasing when it comes to, savings.
Yeah. Which I'm guilty as of it too. It's just like, when you have drops in income, even our real estate market overall, like when you drop 40% in closings, like it has a dramatic effect on, business ownership, commissions, that type of stuff. Even though we kind of had set our lifestyles at a certain income level, it is so much harder to move your lifestyle down than it is your income. It's such a lag for you to do that. And there's so much emotional, things that you got to go through to be willing to sacrifice and live below your means. So you just see this lag of the market that just consumer debt's going to go up because we just want to keep living the same way, Federal debt record highs, $33 trillion of total public debt. This is, I read a report the other day that also is some of the pressure that the Fed has to lower that Fed funds rate is we have allegedly around 17 trillion of this 33 trillion debt that is needing to be refinanced over the next several years because we didn't take the opportunity to refinance it under the lowest interest rates that we had. So there's going to be a pressure on us actually getting that Fed fund rate down so they can refinance some of that federal debt. Right now, we have such a big chunk of our federal budget going to interest that if all that 17 trillion got refinanced under current rates right now, it would move us to almost 60% of our federal budget or something around that stat going to interest payments. So it's gonna become a bigger burden with a number this high for us. Annual personal savings rate of disposable income down to 3.7. Kind of hovered around there the last 2 years. Clearly, we were saving money at a high rate over that 12 months post-COVID. But this is a lot more sustainable numbers, somewhere around that 8% on average. We've got to figure out how to get our annual personal savings rate up. And then deposits of all commercial banks. So, whether people are pulling it out or they got less money in savings account, but we've seen this decreasing. All commercial banks deposits have pretty much decreased every quarter for the last, 6, 7 quarters, something like that, which also is what tightens up some of the credit availability as well. Manufactured durable goods, new orders in millions. You can see we're outpacing that trend line right now, which overall, Gordon, we've kind of still been just producing, manufacturing, and ordering things at a higher than trend line on a lot of these stats, but you're anticipating these coming down.
Yeah,
over the
if you
next-
look at the next two slides, it's gonna show a truer picture.
Here's your index, but this is the one that we talked about yesterday. So pretty much all these
Yeah.
categories, you're either you're either growing or contracting, but manufacturing purchase manager index is contracting, which is shrinking. New orders are shrinking, employment shrinking, inventory shrinking, prices are decreasing, backlog of orders, new export orders, imports, yada yada.
And this is what a purchasing manager is gonna be looking at every month at the first of the month to see how much they need to purchase. Especially when the customer inventories are going down so quickly.
Because we're a service industry, so like we don't even know what it's like to carry inventory traditionally, but like carrying excess inventory is one of the biggest ticking time bombs for a retailer, a product business, having that, because you're losing so much of your capital in inventory. So they're always trying to get that sweet spot of having enough to fulfill retail orders. You have too much, you're losing a lot of money. You have too little, you're toast, because then you have some customer challenges. But overall, we're projecting people are going to be buying less stuff than they have been over the last 2 years.
Yeah, and the challenge has been, even through COVID, we did just in time, a lot of stuff just in time purchasing, and COVID destroyed it because all of the supply chains.
Yeah.
So people started stocking up, and then our inventories went way too high. And then they had to pay interest on that and discount it just to get rid of it.
Yeah.
So now we're just kind of getting into that place where we're almost starting over
Yeah.
in 24.
Yeah, even I bought my new truck in 2021, which again, worst time to buy things, but I paid more, but there just was no inventory, so I had to just order it from the, dealer, from the factory. It took 9 months to fulfill that truck order. Just crazy how slow things were back then. Advanced retail sales purchase percentage change. So this is kind of again projecting, future retail sales. U.S. Index of Consumer Sentiment. We've rebounded from 2022, but again, we're still a little bit lower than that trend line, but I think it's progressing a little bit in the right direction. You can see December 2023, we bumped up to 69, which is higher than, the majority of the last 2.5 years, but still a little lower than we want. Misery Index is basically unemployment rate, including the inflation rate. We peaked right there after COVID, but even just right here, 12, 11, 9%, we have dropped down to 7% on the index of misery. And then let's hit the Utah economy. How old are these again, Gordon? November. So these are pretty up to date. The most recent they put out. We are the 12th most favorable state on annual employment growth. We're at 2%. The United States is 1.8. We're still the youngest median age at 31.3. US is at 38. Still largest household size. Utah 2.95. That 0.45 extra kids per house. US is at 2.5. More Utahns work. We have the first highest labor force participation rate, which also plays into us having a lower median rate, which increases that participation rate. Second lowest poverty rate, 8.2%, Utah, US 12.6%. Who's the lowest? California? Just kidding. 8th lowest unemployment rate, 2.8%. Second highest median household income. So again, just so many things that just continue to rack up of why Utah still is incredible, despite some of the affordability challenges we have, which means our problems are a little less problems than other states for sure. Here's your job change by industry. Mining shrunk a little bit. Construction, since the end of November, 1 year change, we're up 2.6% on construction. That shocked me. I thought we were going to start seeing construction actually decrease a little bit as there's less construction kind of coming online, but construction still to the end of the year has been very healthy. Manufacturing, flatlined. Information industry up 6.2. Financial, which has been one of the strong components the last couple decades, they kind of flatlined. Our education, health services. This was a great one to kind of rebound. I know they've just, they had a hard time after COVID, but leisure, hospitality, probably a lot of our ski resorts and some of the tourism, whatnot, other services, and then government has increased 3%. Non-farm employment Overall, right there, we're at 2.1% growth of non-farm employment. And then here's our yearly unemployment for Utah, 2.5%. United States was at 3.6. Here's your monthly. Slight increases the last 2 years, but still right there at 2.8% unemployment, which is, again, I say this every time, but one of my economy classes in my degree says we should always be somewhere around 4 or 5%, because there's always just about 4 or 5% of working able-bodied people might just not have jobs, or they choose not to have jobs, or they're poor workers or something. So normally if you're under 5, it's still, you're scraping the bottom barrel of potential workers out there for companies. You can see health of Utah's industries just on the rate of change and the change in unemployment. So just the top right is going to be your biggest expanding categories. You see trade, manufacturing, mining, a little bit on some of the contracting percentages. Quarterly gross domestic product, kind of where we stack up in the country. This whole out east, it's been crazy to see a lot of that GDP growth, but still 6.3%, pretty dang healthy. Is it even shrinking? 1.1% on Alaska. See any lower? No. Just overall GDP growth. Real GDP, 214 billion, 2022. Here's some of the year-over-year changes. Other than 2020, we've kind of consistently grown, except that Great Recession.
And then they readjusted in 2017 for inflation, so that kind of bumped and screwed up all of our numbers backwards.
Because they weren't taking inflation into play before that, so they kind of caught it up in 2017.
Yeah, and I don't know why they didn't adjust the whole section, but the Fed didn't.
Personal income growth in Utah, you can see we traditionally outpace the United States. We're yellow there. So Q3 is the latest data, up 6%. And then construction. So here's some of our construction. You see new single family homes started in the country. 14 years. These are starts, not completed units, which we talked about, but these are starts. Which that trend line's right there at 1 million starts. So we did decent in 2021, but still not starting as many as we need. And we're trending down on family starts due to some of those other challenges. Units is your purple. So this is units completed. Your orange is building permits. So our units completed kind of on that somewhat trend down just the last several months, but overall with that growth that we had, during the COVID years. And then here's your orange, but still some of the builder permits not being pulled. Residential housing starts for Utah, 29,000 in 2022, 40,000 starts in 2021. Residential housing starts by year, just in value. So 7 billion, or is it 7 trillion? 7 billion, 7 trillion? Billion. Price indexes of new under construction. No doubt prices
Still going up. This one I don't have year end yet.
Okay. Price index of new multifamily residential under construction. Here's your builder confidence. We were cruising up there towards the middle of the year. There might be some seasonality in this, but I was surprised to kind of see as much of the decrease as the last half of last year that we experienced on the builder confidence index. I think once we get through the rest of this winter, I'm guessing this is going to kind of go up as we get back into the springtime. Hopefully, year over year, builder confidence dropped 27% in 2022, 24% drop in 23. We can just look at that 2011 to 2012 when we kind of just really felt like we recovered from the recession. Just 108% increase in builder confidence year over year. Some of your total debt balance and its composition, trillions. So we got this till the end of Q3, but overall we're at $17 trillion debt balance. You can see where the majority of the debt is. Purple is your mortgage. Home equity revolving is your orange. Auto loans is your gray. Credit cards is your yellow, and student loans is your red. And then the other category is green. So most of the division of those debt categories is somewhat staying the same. It's just overall debt is all going up, $17 trillion. Mortgage originations by credit score. So your green's going to be your best credit scores, your yellow, your red. So just You even look 2007, 8, like how much of that sub 620 was still getting mortgage originations, which is almost like disappeared since we kind of corrected from that mortgage market back then.
And that's why we're gonna be more stable going forward unless they start changing things.
Yep, yep. Just healthier mortgages for sure. But just look at the green, man, that is a lot of mortgage origination. That late 2020, early 2021 time period. Auto loan, same thing. Auto loan origination by credit score.
But you go 19 through 23, they obviously have not learned their lesson with subprime.
Yep.
And that's what's gonna get us, I think, in the next couple of quarters.
Hmm. Total debt balance by delinquency status. Still really low, just above that 3% on severely derogatory, just all those added together. But you see greens 30-day late, 60-day late blue, yellows 90-day late, orange is 120, and severe is beyond that time period. Look at all that debt that was delinquent.
Household balance sheets decreasing as far as just savings in the bank. It'll be interesting to see that trend if it starts to increase over the next couple of quarters.
Mm-hmm. Percent of balance 90-day delinquent by loan type. This is a lot of the legislation that's happened that people just deferred, or they thought their student loans are going to get paid off, whatever. So that was kind of manipulated one. But you see credit card delinquency has just skyrocketed.
And the student loan one, they pushed that out through 24. So we're not going to truly know until 25 where we're at on that.
Yeah. It's always good to push problems into the next presidency, right?
Right.
That's usually what happens. The next guy will figure it out. Number of consumers with new foreclosure and bankruptcies still very, very low. Foreclosures, bankruptcies there.
And look what happened back in 06. The bankruptcies went up before the foreclosures.
Yeah, that's interesting. By what? Almost 2 years you saw bankruptcies happen before foreclosures. Oops. Okay. Here's third-party collections. Proportion of consumers with collection. So that has dropped quite a bit, but average collection amount per person has gone up. Oh,
I think that's the last slide.
oh, sweet. All right. Okay, Shoni, let's wrap up with some final thoughts.
Yeah, I would just say it's actually pretty simple. If we look at some of the changes that have happened in the market, I think there's a kind of the old way of selling real estate and being a real estate agent, and the new way. And the reality is the old way is just helping the client through the transaction process, right? Finding homes, negotiating, getting them to the finish line, which is one part of the puzzle. But the reality is what clients want today is a market expert, right? Somebody who actually understands the data that actually makes the market, and understanding affordability and how we can provide solutions to clients. And so we really have to just study up on these things to be able to properly guide clients through the process and position ourselves as a real estate consultant, not just an agent, especially with all the lawsuits and things that are going right now. The agent value proposition is what's at challenge. And so we have to be better at making sure that we're properly educating clients and just helping them with the solutions to today's biggest problems.
Yeah. And also, as always, if this is your first time on kwutah.com, we always post these slides. We highly challenge you to use them in your appointments and whatnot. Even you presenting this data just helps you kind of internalize it. We do record this, put it on kwutah.tv that goes straight to our YouTube channel in case you want to rewatch it. Robert does that at least 3 times every quarter. We appreciate that. But again, my thoughts on this, I am so optimistic about this year. We hung in there, we survived. We still have a lot of agents that did very well in 2023, but I am predicting a better year in 2024. Obviously mortgage interest rates, some of that, but like we even see a half interest rate or anything drop, like you're just going to see a lot of this, on the fence demand that's going to jump out. I think March is the next probably real Fed reserve thing you want to pay attention to, but I'm excited to roll through this year. I got a lot of energy. A lot of my companies and businesses I got we're anticipating a little bit of the gates opening and a pop of some productivity. So just keep doing what you're doing. Go get the market share, and as the market expands versus contracts, you'll be rolling in some closings. So appreciate being on. Thank you as always, and we'll see you next quarter on our market report. Thanks everybody for being on the call.